With all of the confrontation and drama that has surrounded this meeting, they're behind closed doors now. Culturally speaking, can the Fed handle this?
I think that the Fed has been put in an unprecedented situation. That said, as you alluded to, we pretty much think we know what's going to happen with the interest rate decision. The Fed has been signaling for quite some time that they were seeing interest rate cuts on the horizon, but not yet. I think markets and the signals we've been getting from various Fed governors from across the political spectrum all point to a quarter-point rate cut. In some ways, that makes the Trump administration's really vicious targeting of Lisa Cook especially surprising and potentially counterproductive. The reason that we all think that the Fed is going to be cutting rates is that we've seen significant deterioration in the labor market. Between last month's job reports and the big revisions we saw, it looks like the labor market has been softer for longer than policymakers understood, and now we're seeing a market slowing. We're seeing job openings below the level of job seekers for the first time in several years, and we've seen a spike in the black unemployment rate, which is both troubling for black workers and often a harbinger of further softening in the labor market to come. And so all of those things are really pointing to the Fed loosening monetary policy to try to boost that struggling labor market. That's been made more complicated by inflation, which remains elevated and which is being driven up by the Trump administration's handling of tariff policy. But all of those things would point to a rate cut. Unfortunately, by undermining the Federal Reserve's independence in the eyes of the market, we are seeing some signs that market participants are going to start to worry that the Fed is not going to keep inflation under control. And that can be a self-fulfilling prophecy that actually makes it harder for them to lower real long-term interest rates, which can be very important.
The irony of this whole thing is that the market reaction to the very fears you've laid out is ultimately showing up on the longer-term interest rate side of things, the very piece that affects the housing market, which is the very crisis that the White House is trying to warn everybody about. Does a 25 basis point or even a 50 basis point rate cut address that? That's exactly right. That what we're seeing is that yield curve is getting significantly steeper. That is, there's less and less difference between what you have to pay to borrow short term, where the market is predicting those interest rate cuts are going to come, and long term, where the long term rate is really driven by the market's expectations about future inflation. And so if what the president is trying to do is bring down mortgage interest rates, we're going to start to see whether the Fed is losing its ability to drive down those longer-term interest rates.
So what's the job for Jay Powell tomorrow? They'll make an announcement on interest rates. The markets will do what they're going to do until the news conference begins. And I suspect that everybody in the room, including Michael McKee, is going to be asking about a lot of difficult stuff that he doesn't want to talk about. Lisa Cook, Stephen Miran, is he going to go back to the White House? The renovations, for crying out loud, at the Eccles building. There's so much that doesn't include data that reporters want to ask about. Does that also cloud the picture for the chair?
I imagine that he is going to try at every turn to bring folks back to the conversation about data and reinforce the idea that the Fed is just moving along business as usual, not getting caught in the noise or the political football, and really just continuing to make data-informed decisions. Because for the Fed to be able to do their job and affect those longer-term interest rates, they really need to signal that they still have a steady hand at the till and that they are going to be making data-informed decisions that can then be relied on to move the markets in the ways that they're supposed to.
The Donald Trump's tariff policy is what's muddying the water, it feels like, even though there's been a bipartisan consensus that rate cuts is what this economy needs, even just a normalization of rates, if not ultimately stimulus. But if you look at the data, it feels like there's arguments to be made here that the U.S. has been able to absorb higher tariffs and higher rates, and it hasn't affected the end consumer in the way that maybe we thought of on April 2nd. Your thoughts? Is it?
We have seen prices begin to rise. And one of the complicated things about the tariffs is twofold. One, just the chaos around what are tariffs, what will they be, what will they be in 90 days, creates a lot of uncertainty that makes it difficult to invest. The other complicated thing about predicting when consumers would start to see price increases is that there's often a big lag on those tariffs. Companies place orders, retailers, for Christmas starting 6 months in advance, right? We have shipping times. We did see a pullback around Liberation Day, and then we saw that filter into prices over the following months. At the time, many analysts were saying, you have to watch and wait, and we are seeing those prices go up. As you said, I do think there has been a lot of strong indication that the Fed should have begun normalizing rates a lot sooner. I was on this show almost 2 years ago arguing that housing prices and mortgage prices were really weighing on consumers, and that the inflationary period from the pandemic supply chain shocks had largely worked its way through. And I do think that you're right that Trump's tariff policies have made it more difficult for the Fed to engage in the kind of rate cutting that many people were advocating for.
But if there's a time for prices to go up for the American consumer, is this the right time? And I say that with the caveat of we're still sitting on COVID-era stimulus. We're still sitting on elevated savings as kind of the broad American consumer. Retirement savings are up. Loans aren't as much of a burden as they were, say, 3 years ago because so many people have paid off their debt. If there's a time for the American consumer to absorb tariff costs, is that now?
I'd be very careful when thinking about things like retirement savings being up. It's true that people who have significant retirement portfolios have seen asset prices rise dramatically. Also, people who already own a home have seen those asset prices rise dramatically. That has driven up wealth for people who have substantial holdings in the stock market and own a home. That is not the majority of Americans. And so I think working people are really being squeezed. Now they're being squeezed on both ends by a faltering labor market and rising prices. And those consumer goods prices and things like groceries and housing costs, those are a big part of the typical family's budget, less so the kind of folks who are seeing those asset prices appreciate and seeing their wealth go up.